Welcome to This Week in Crypto from K33 Research. Today is June 12th, 2026. A written version of today's analysis is available at k33.com/research. This week, 4 stories stood out. On the surface, they seem unrelated. One involves the Middle East, another involves Congress, a third involves tokenized stocks, and a fourth involves Morgan Stanley. But together they point to a larger trend. Crypto is becoming increasingly integrated with traditional finance. The clearest example may be the rapid growth of tokenized assets, but the same theme also appears in regulation, institutional adoption, and even broader macro developments. Let's start with the biggest macro story of the week. Reports suggest that the United States and Iran are moving closer to a draft agreement that could ease tensions around the Strait of Hormuz. The details still require final approval, and negotiations remain ongoing. For markets, however, the key point is not the agreement itself. The key point is the potential reduction in geopolitical risk. The Strait of Hormuz remains one of the world's most important energy shipping routes. Any reduction in uncertainty around the region could help stabilize broader market sentiment. For crypto investors, this matters because digital assets continue to trade as part of the wider risk asset universe. A more stable geopolitical backdrop generally creates a more supportive environment for risk-taking across financial markets. The second theme is regulation. Congress spent part of this week debating how digital assets should be taxed. Lawmakers discussed issues ranging from small transaction exemptions to the treatment of mining and staking rewards. While there was broad agreement that the industry has become too large to ignore, there was less agreement on how quickly new rules should be implemented. The debate itself may be more important than any individual proposal. Crypto taxation has moved from a niche policy issue to a mainstream legislative topic. The industry is no longer arguing whether rules should exist. The discussion is increasingly focused on what those rules should look like. That shift reflects a maturing market and a growing recognition that digital assets are becoming a permanent part of the financial landscape. The same trend is visible in the continued growth of tokenized assets. This week, Securitize moved one step closer to becoming a publicly listed company. On its own, that may sound like a routine corporate development. In reality, it says a great deal about where the industry is heading. Securitize has become one of the leading platforms for tokenized real-world assets. Its progress toward a public listing highlights how tokenization is moving beyond experimentation and becoming part of regulated financial infrastructure. Some of the world's largest financial institutions are already participating in this market. As a result, tokenization is increasingly becoming a bridge between traditional finance and blockchain-based markets. That broader trend is perhaps most visible in tokenized equities. One of the strongest growth stories in digital assets this year has been the rise of tokenized stocks. The market has grown from roughly $2.2 billion at the beginning of the year to $5.5 billion today. Much of that momentum has been driven by investor demand for exposure to private companies such as SpaceX. Traditionally, access to these opportunities has been limited. Tokenized equities offer an alternative path, allowing investors to gain exposure through crypto-native platforms. The significance extends beyond SpaceX. What matters is the growing demand for financial products that combine the accessibility of crypto markets with assets that traditionally existed outside the crypto ecosystem. If this trend continues, tokenized equities could become one of the most important segments of the broader tokenized asset market. Finally, institutional adoption continues to move forward. Morgan Stanley and Galaxy Digital announced a structure that allows eligible clients to convert crypto exposure into regulated investment products without first selling their underlying assets. The announcement may appear technical, but the implication is straightforward. Large financial institutions continue to build infrastructure that makes digital assets easier to integrate into traditional portfolios. That has been one of the defining trends of the current cycle. Rather than forcing investors to choose between traditional finance and crypto, institutions are increasingly creating products that connect the two worlds. To summarize, This week's developments all point toward the same conclusion. Digital assets are becoming more integrated with a traditional financial system. Regulatory discussions are becoming more sophisticated. Institutional infrastructure continues to expand. Tokenized assets are growing rapidly, and investors are increasingly looking for ways to access traditional opportunities through crypto-native channels. Thank you for listening to This Week in Crypto from K33 Research. Subscribe for future market updates and visit k33.com/research to read the full report and explore our latest research.